Thank you, Nellie, and all the other panelists. That was a really good and productive, I think, set of presentations that came out with several concrete suggestions. Central clearing of treasuries, central clearing of repo, a little relief on the leverage ratio, reform of mutual funds, increasing bond liquidity, liquidity in corporate bond markets. I think one question that comes up, and it's come up in the audience questions too, is how are we going to get this done? So we had a bad episode 10, 11 years ago. Out of that came an act of Congress, which gave the Federal Reserve and the regulators the opportunity which they took, or the instruction really, which they took to strengthen the banking system. We've had another stress. It's manifested more, as Beth noted, it's manifested less in the banks and more in the securities markets. Do we need a Dodd-Frank or whoever the current Crapo, whatever, for the securities markets? How are we going to make these changes? Clearly, the private sector doesn't have the incentives to, doesn't seem to have the incentive to do it themselves. So there are externalities from the behavior in the markets. How are we going to get the private sector to internalize them? Can this be put together under current law? Does it need new laws? How are we going to get in our fragmented regulatory system? How are we going to implement the great suggestions we've heard made today? Anybody want to talk? Daryl?
Sure, Don. That's I mean, you've asked the $64 trillion question.
That's what they pay me for at Brookings, Daryl.
Well, you know, I was talking this morning with Ken Garbade, who's probably the leading historian on Treasury markets. And he said, you know, this has happened before on the Treasury market. It happened in 1939, it happened in 1958, and in 1970. In each case, the Treasury market became dysfunctional. The Fed came in and corrected it. And so we could, you know, not go to politicians and simply say, the Fed can fix this every time it happens. That makes 4 times a century if you count the one this March. But if you looked at that chart I showed on the growth of treasuries and the increasing US indebtedness, debt to GDP way over 100%, you can almost think that the treasury market becomes a matter of national economic security, and that Congress will, if prodded by regulators and administration, eventually come to grips with what to do to make this market the foundation that it needs to be. It is still the world's safe haven. It is still the world's most liquid financial instrument. But can we continue to rest on that and leave it up to market forces to figure it out? As you said, there are a lot of vested interests. There are a lot of, there's a lot of, maybe everybody wants this to work better, but no one has the incentive to spend the resources necessary to do it. And the official sector is going to need to come in and make it happen. It could happen in a supervisory manner, I suppose, but it's complicated in the treasury market. When the repo market was found to be in abysmal shape in the financial crisis, I remember meetings at the New York Fed in which leading members of the Fed came in and said, if you don't fix this, we're going to need to make it happen. And the private sector was able to do it just on supervisory guidance, let's call it. But I'm not sure with the treasury market, there are so many players, it's so big, and there are so many agencies that need to come to the table, and private sector market participants. I'm not sure it can be done without legislation. I'd be really interested in your views. You've played between that. I remember your testimony in Congress when the Congress asked about what the Fed was doing. What do you think, Don?
Well, I think it seems difficult for the Treasury market participants to agree on this. They discussed it. put out a white paper that said they couldn't reach a consensus. So it's going to take some forcing action of some sort. I'd like to ask Beth to react to this conversation as a major market participant, and also ask her about the central clearing of repo. On the leverage ratio, I think everybody understands how that might happen. Now, whether it's the right thing to do is another question, but you suggested central clearing of repo. How is that going to happen? And can you react to Daryl's suggestion on central clearing of treasuries?
So I think that the markets, we talk about markets as this monolith, this force in and of itself, but the markets are really just made up of a series of participants who are all acting with their own set of incentives and their own goals. And I think what we've seen over the past 10 years is, as you put in place one series of regulations and rules, the activity in the market migrates to other parts. And so it's really just a series of choices and trade-offs and pros and cons for where you want this activity to live, where you want it to be housed. And so as there were more and more regulations put on the banking system, you saw the asset manager community grow in tremendous size. And so now you're seeing, when you think about things like ETFs or some of the mutual funds, some of the implications of having things migrate to that sector. I'm sure there will be a series of legislation and rules coming out of this crisis that will migrate that activity to some other sector that we will then in the next crisis have to go and repair it. But I think it's really just a series of choices. When you look at central clearing for either repo or for cash treasuries, there are some pros and cons. Again, it's all just trade-offs. For cash settlement of treasuries, the TMPG, the Treasury Markets Practices Group, sponsored by the New York Fed, had done an extensive white paper really looking at where some of the risks were in the system. And while it did tend to focus on, I think, some of these risks around settlement and clearing, they're very, very short dated risks. They're very, they're very finite, and they're limited to hours to, a day in terms of time frame. I don't think what we saw happen in terms of liquidity issues in this crisis are related to those settlements. And so to me, the forced settlement or forced clearing of cash treasuries, while it would create some more visibility in the system, would also add some expense to things like the mutual funds, pensions, and insurance company, who may or may not, want to bear those additional costs in the system. For the repo market, that is a place where I think we've tended to see a lot more focus and a lot more fragility over time. And I do think a number of the rules, some leverage, some capital, and other rules, have really increased how much of that market is trading on a short dated basis, so on an overnight basis. And I think moving that towards central clearing, while it will increase the risk at that central counterparty, will probably give better transparency, better visibility, and I think help increase the volume of repo that can be executed, because you'll be able to offset it through that central clearing counterpart. It won't eliminate the credit risk, but it will increase the ability to net down and grow the amount of capital dedicated to that activity.
So do you agree with Daryl that the netting in central clearing would free a lot of dealer balance sheet space, both repo and treasury? It's that important.
I think it's more on the repo side that it would free things. I don't think it would free things necessarily on the cash side, because I don't think that's a very large exposure. That overnight or intraday exposure is very significant for most of the banking system. But I do think on the repo side, it would free it up.
Thank you. Ite, you've suggested mutual fund reforms. How can the SEC do that by itself? Does it take more impetus from the supervisory or the regulatory sector? Would it take some legislation? How are we going to? And include in your answer, and I'll turn it also to Nellie, the money funds. So would your recommendations for mutual funds generally help on the money fund thing? Twice in 11 years, the same instrument coming back to bite the system. That's really fool me once, but fool me twice, right? So what would you do about these mutual funds, and would it apply to the money funds?
Yes, well, These are very good questions. Let me first echo what Beth said about one type of regulation creating migration of activities to somewhere else. And I think we have seen that now very clearly. I see a clear link between the regulation that was imposed on banks after the 2008-2009 crisis, and now the fact that the activity is mostly in security markets and the growth of mutual funds and ETFs. I think there is a direct link there. So when you ask, should we expect the SEC to do this or that, one thing that I think we should think about more is the system as a whole, and have collaboration in how things are regulated, and always take into account that if we create some restrictions in one part of the system, then activity is going to go elsewhere. Regarding the mutual funds, some actions have already been taken prior to this event. And there was a lot of discussion, as I mentioned, since the 2008-2009 crisis, as the growth in mutual funds in corporate bond markets was very apparent. There was a lot of discussion, and eventually some steps have been taken. So there is some liquidity regulation, and maybe most importantly is the swing pricing regulation that passed just recently. But it's still very new. So I think in some sense, maybe if this crisis happened 2 years down the road, we could see better what is the effect of this regulation. But since the swing pricing is so new, then I think we still can't really see what would be the effect. But I think swing pricing can do a good job, and there is some evidence from other countries where swing pricing has been implemented, that it is effective in reducing the fragility of funds investing in fixed income markets. So I'm optimistic that something like this could happen. I would like to also say something about the liquidity of the underlying corporate bond market, which I think is also an important point to take into account. There has been a lot of discussion about this. Corporate bond markets, to a large extent, are still outdated, not keeping up with a lot of what technology could offer. And taking this step forward could improve the liquidity and then reduce the liquidity mismatch between the underlying asset and what investors are getting. So I think this is also I'm not sure. I think there are a lot of conflicts in the system that prevent this from happening, but it seems to me like a step that is quite natural to take.
And would the swing pricing help on the money funds? How would that work on the money funds?
Yes. So I mean, the idea behind swing pricing is that when you want to take your money out of the fund, and if you do this on a day where there are many other investors doing it, then the price is going to move against you. So in some sense, it kind of deters you from taking your money out when you think other people are going to do it. And this reduces this first mover advantage that I think is behind the run problem. You can implement something similar to that also in money market funds. Money market funds, if you think about how they evolved over time, there was the whole fixed NAV issue, which was thought to be the main source of fragility in the 2008-2009 crisis. And funds have moved away from this to some extent. I think swing pricing will be going in the same direction, going further in the same direction.
Thank you. Nelly, would you like to react to what you've heard? And in part, Zite just said, we need more cooperation, coordination among the regulators. Yeah. We have a federal agency or a federal group, Financial Stability Oversight Council, FSOC, that was put forward in Dodd-Frank exactly for that purpose. How well do you think that's working? Is it a vehicle that could be used in monitoring or in regulating things away from the banking system, which already have their set of regulators? Talk a little bit about these implementation problems we've been discussing.
Sure. I'm going to say just two things first on money funds and underlying corporate bond market liquidity. So on the money funds, I think this is an area the SEC itself could make changes as they did in 2014. Perhaps they got a push from some of the other regulators, including from FSOC, to go a certain direction. But where the prime institutional funds dropped the fixed NAV and went to floating, at the same time they added the 30% rule and the gates. And I think, gates that threaten to close in stress tend to be accelerants. So in this case, getting rid of gates, simplifying regulations may actually create what you need, and something to think about. As I mentioned, the data are right now that are available for most of the analysis seems to be at an aggregate level. There should be people who are working on fund by fund analysis and making sure that the story everybody is saying is actually true. But I think this is a ripe area for reform. The SEC could do this on their own. If they wanted FSOC help, I'm sure FSOC could support them and help, and other agencies along the way. Corporate bond market liquidity, I think, is actually a much harder issue. Of course, it's illiquid, but there's just so many different corporate bonds out there. This issue keeps coming up multiple times. Decades ago, whether companies could become benchmarks and issue 5-year debt on a regular basis and become a benchmark and presumably get a liquidity premium for that. There didn't seem to be very much take up from corporations. So what regulators perceived as a benefit, the private corporations thought it might be too costly for them. I don't know the answer, and I don't know if central clearing would solve the particular problem. What I am concerned about is that there's a sort of set of products that keep getting built up on top of what are securities that are fundamentally illiquid, but they continue to offer liquidity without sort of pricing it in ex ante. And the Fed can help on the money funds, this time with Treasury capital, and in the corporate sector, it really is a whole government effort. And so maybe in terms of implementation, there will be more consensus behind making some reforms, because it does use upfront taxpayer money. That would be a hopeful interpretation of one of the consequences of this. So what's the role of FSOC? So I think this is an entity after the financial crisis created to help look at the system as a whole. It has pretty limited powers, as you know, because you being on the UK FPC with what appears from the US side, unlimited powers, and the US has very few. They can designate, but that has limited applicability to many situations. And they can write annual reports and make recommendations. But those reports have to be signed by all 10 members of the Financial Stability Council, personal attestation. And when you write anything that requires 10 organizations or people to agree on, what gets written is going to be sort of a broad consensus. And so many of the issues that they may actually look at internally won't kind of get surfaced. I guess they seem to have a framework, though, that actually identifies. So if you go back to their last annual report, they will talk about hedge funds leverage that has been increasing pretty rapidly, and the concentration of hedge fund leverage. They will also say, boy, we actually don't have data on a timely basis. Our last data is June 2019. And even the Fed's annual report has June 2019. It's an annual and it comes lagged. They will actually also mention agency REITs, which had pretty big problems in this last crisis. They do repo on agency, RMBS and CMBS, but evidently some other stuff. But when interest rates fall, they took a huge hit and there were margin calls and they had to sell. That was pretty disruptive. These are identified in the financial stability report as potential issues. I guess, so you can identify vulnerabilities in the system. How you can like play out the scenario and how it's all going to play out when some shock comes along, totally unexpected like COVID, is hard. But I think the mechanisms are in place to do the scenario analysis. The question is, what's the will and the proper incentives to actually follow through on more? And, you know, there isn't sort of this migration of banks to non-banks. There isn't sort of this general sense of what's the appropriate amount of risk in the financial system we can live with or want to live with. And I think until you get something like that, a broader consensus, it's kind of hard, even when you identify problems, that you move in ex ante and try to fix them all, unless they're pretty egregious. So I would say even that's true for banks, but somehow we've figured out that there are certain capital ratios that are appropriate. And so you can measure them against these capital ratios, but it isn't true in almost any other sector, the financial sector. So there are some pieces in place, but it's not quite operational all the time.
Thank you. Great set of answers here. I think I want to continue on this migration issue. I think as you mentioned, I'm on the Financial Policy Committee at the Bank of England, and we have looked around the regulatory perimeter every year. That's part of our regular process. It's hard to do stress tests on the non-bank system. You don't have the information. Things are different. And then what do you do about it when you get the answer? So I think partly this is spotting these things and then figuring out what to do is a pretty big challenge. Daryl, as an academic out there in Stanford, do you have any words of wisdom to the regulators about how they should track the migration and spot the problems before they require the Federal Reserve to intervene? I think you're muted, Daryl.
Thanks, Don. Yeah, there's an increasing set of data available to regulators. I'll give you one example, which is called TRACE. Prior to 2003, there was no data. There were no data on transactions in the corporate bond market. And now we know essentially every single transaction, and the regulators have an enhanced version that tells them who is on each side of those transactions, the prices, the quantities, the exact moment of the day in which those trades occurred. Now that those data are available, we can conduct studies for in both the equity and the bond market. So which prices are moving first, who's trading, on what information. And in the treasuries market, FINRA has been comprehensively collecting data on every single treasuries transaction. So the cost benefit analysis that Beth mentioned about, is it cost effective for repo and not for cash treasuries to be centrally cleared? We could answer that question now without going to Congress for legislation by, let's say, the Treasury Department maybe seconding the Fed to take all those transactions data and do the cost benefit analysis. And that's much cheaper. And this is sort of hinted by Nellie's comments, much cheaper than leaping in one go and just forcing the change on the market without the necessary study in hand showing the cost benefit analysis. So I do think it's possible to do a lot of what we've discussed with respect to migration. Everything that's exchange traded or in the corporate bond market or in the treasuries market, it's migrated away possibly from banks, but it's not migrated away from our ability to see what's happening.
And you would include in that the leverage in the REITs and in the hedge funds that Nellie was talking about. So the authorities should have enough information to see rising leverage. Whether they have the authority to do anything about it is another question, right?
Well, sometimes the authority comes from being able to say that you know what you're talking about and being able to prove it.
I think the authorities have some visibility, but I don't think we should overstate what they can see. I mean, they have reporting on the Treasury's data, which is useful, but I don't think they have reporting on the leverage. And certainly their visibility into the hedge fund community is not what it is for the banking sector. And I think that would go for the REITs as well. To my point of it, it's trade-offs in information. I think like Schrodinger's cat, you have to think about how the markets change when they're being observed. And I think the trace data is a good example where giving the information to regulators, but not necessarily the full public as it's being done in the treasuries market is different from what's happening in the corporate bond market. And I think what you've seen in the corporate bond market is the publication of that data changed a bit of the behavior. So then you have to go back and reanalyze what some of those movements are. But I think it's an excellent point that more of these types of cost benefit analyses, I think, need to be done. Because I do think that all of these crises will breed other issues. And I think, Nellie referenced it, the 30% liquidity stores that the money funds now need to hold. Because they're holding that, it's really valuable for them in the case of a crisis when they need to use it. But because it's publicly reported, they've been unwilling to use it or go below that 30% because that could create some of these pro-cyclical effects. And so again, I think getting the balance right between observation and reporting and transparency is a fine line that needs to spend more time on.
Great, thank you. Ite, could I ask you to reflect a little bit on the ETFs and the bond funds? So this was a point that Nellie brought out, that the ETF prices really plunged much more than the net asset values of the bond funds, and could have provided some incentives for some of the redemptions from the bond funds for first mover advantage to get out of those bond funds before the NAVs caught up with the thing. So the ETFs look like they were a source of information, maybe better reflected the underlying prices. Do you worry about ETFs as well as mutual funds and the dynamic between the two that Nellie was discussing?
Yes, I think ETFs are very interesting, and to some extent, they don't have the same underlying mechanism that creates the first mover advantage like mutual funds. Right. Because when you take your money out of a mutual fund, you're just being paid based on the current net asset value. And then essentially you impose all these transaction costs on the remaining investors. And this is what creates the first mover advantage. In an ETF, when you are an investor and you want to take your money out, you need to sell the share of the ETF in the market, and then the market price will fluctuate to reflect that. So in some sense, you are bearing some of the cost. But the whole ETF mechanism is based on these authorized participants, APs, who are then redeeming and creating shares to make sure that the price of the ETF will be the same as the net asset value. And I think when you see the price of the ETF drops and this discount opens up, it's basically a sign that these authorized participants don't have the incentive to do it. Because I think what happens is they are concerned about the illiquidity of the underlying bond market. And they're concerned that eventually they will not be able to get the NAV as what it is stated right now if they go and then sell in the underlying bond market. So in some sense, I think this liquidity mismatch shows up again, but just in a different form. And by looking at the discount, I think is probably where it manifests itself. I think we need to study it a bit more. But at the end of the day, it seems to me that the same problem, that there is an underlying illiquid asset and investors think that they have this liquid security that is attached to this asset. I think it's there also in ETF. It just shows up a bit differently.
Although the ETF has the swing price built into it, basically.
Right. Yeah.
So,
yeah. So the fact that you have to sell it in the market, it's kind of like a swing price
Right.
in some sense. I think, I haven't seen sort of a rigorous study on this, but I would like to ask to what extent those prices adjust in real time, and to what extent indeed they serve the purpose of a swing price.
Thank you. So I'd like to turn a little bit to the Fed. A number of the questions that came in on email involve the Fed's actions and were they appropriate and what happens next. So Nellie, you featured Fed actions on your last slide. Do you have any, how do you think they did? Our old friends, I won't say former friends because they're still friends.
Yeah.
The Federal Reserve, how would you grade them? Did they do some stuff they didn't need to do? Are there things they should be thinking about doing next? How did the Fed do without our advice?
I'm sure it would have been better had you been there, Don, but
More you,
so
Nellie.
they were so very aggressive early, took decisive actions, I think well warranted, especially in the short-term funds. They really did cut off what could become serious lack of funds in the short-term market and become credit problems and perhaps solvency problems. And they pulled out, as everyone has said, the 2008 playbook, and sometimes with the exact same terms and spreads, and then adjusted them a week later to adjust the current situation. But I think the stability of commercial paper, the stabilization of money market funds, their purchases of Treasury and their provision of repo actually starting back from last September, they've done quite a bit. So I think the big changes that they've done, in part, they moved into munis. First in the short-term funding, the MMLF will take some short-term municipal because of the tax-exempt money market funds also have gate. They're floating with gates, and then corporates. And I think this is a big change. I think typically the Fed wants to provide credit to support corporations to make payroll and spend and invest. But the way to do that efficiently, in their view, was to go through first the secondary market. So they opened up in the secondary market, and a broad way to do it is through investment grade bond ETFs. And so far, actually, the announcement has had a big effect. They haven't done all that much yet. It wasn't even clear if they actually needed to do much, but my guess is they felt like they should. And maybe that's, otherwise it's not credible. But it has definitely helped. But what I do hope is that it doesn't set up a view that the Fed and the government, in this case, will always be there, and that is the backstop, and that it doesn't sort of hold back possible reforms where somehow liquidity is being paid for ex ante through some mechanism, whether it's central clearing or fees or or better lines with dealers. But so I think all in all, but and then the next steps, of course, and Beth outlined this, is to get the recovery going and getting credit to businesses through TALF, households and businesses through TALF and through Main Street. This is a huge step for the Fed to be involved in loans, not market-based finance. They'll try to use the banking sector and the private sector to select the loans and the securities. It's a big step, but I think the broad view that this kind of shock didn't have sort of the moral hazard elements of it up front that the 2008 crisis did. Like, you're not helping those who got you here in the first place, that got you into this trouble in the first place. It gives them some freedom, but it doesn't ensure that the next time there won't be this. So overall, it's been, I think, super important that at least the financial sector itself isn't going to cause any economic strains to get worse. So you take that off the table, and then you have fiscal and healthcare to help you manage the rest of the crisis, get the economy on track.
Let me turn to Beth as a market participant, pick up on Nellie's last points about, in effect, the moral hazard of the Fed stepping in twice in 11 years. Do you think market participants will be less relaxed about risk because the Fed has been back there the last two crises, and that its being there will reduce the force behind their acceptance of the necessary reforms that our panelists have outlined here?
So I don't think so. When we think about, and I can't speak for all market participants, for I am humbly just one, but when we think about our own risk management, we certainly operate in a way that we want to continue to participate in markets and be able to sustain without expecting any sort of government facilities or intervention. And there's a lot that's already written into the various regulations that would encourage certainly the banking system to not expect that type of participation or exigent measures to come in place. That said, I think the two crises we're looking at, 2008 and the COVID crisis, are quite different in nature for a variety of reasons. Certainly in this crisis, it's in a lot of ways more akin to what happened in 9/11 than it is to what happened in 2008, in that it really didn't start in the financial system, was completely outside shock to the system. And frankly, I do think that a lot of the programs that have been set up have been with using the banking system in mind to help get those dollars and that stimulus to the real economy. And I think that, for many of the market participants, you need to think about it in that frame. That said, anytime the Fed comes in as aggressively, and again, appropriately aggressively, as they did here, you do have to think about moral hazard, and you do have to think about what that's going to do down the line. I do feel like the banking system, at least, is very well supervised and very well advised in terms of how it's going to be behaving here. But I do think there are other areas, like potentially, some parts of the mutual funds, the hedge funds, the REITs, other sectors, which maybe have less oversight and certainly less regulation. And you want to find that balance between making sure you're keeping the system overall safe, but allowing free markets to behave. When as a market participant, when I look at the full complexity of what the Fed has done and think about places where maybe more could still be needed, I think there are two areas that stand out to me. One is, I do still think for the municipal market, the state and local governments, while they're included in some of the programs, I think the scale and scope of what's going to be needed there is still quite dramatic. And I think there could be more that may be needed there. And then I think the second one is really in the real estate sectors. I think that we've seen, some amount of support, but not all parts, particularly in the commercial real estate markets, are going to necessarily make it through. But again, I don't think the Fed or Treasury, as Nellie rightly points out, should be in the business of picking the winners and losers. Businesses need to operate and sustain themselves and make sure that they're robust enough. And the Fed and Treasury should help support, where they can when there are these exigent circumstances. But again, not every company, should or will make it through this crisis.
Great, thank you. Well, we're just about out of time. I think I would close. That was a great almost summary of sort of where we got to and the Fed's role here. I think I would close with a thought, which is there is a role for the Federal Reserve in the banking system as a lender of last resort. That's what happened in 1913. So the private market, the legislature decided that the private markets couldn't handle this. They needed a backup source of credit, but they also needed much greater supervision and regulation. That was also in the Federal Reserve Act, in the preamble of the Federal Reserve Act. So I'm wondering, this is another panel we can do sometime, whether there isn't a role for the Federal Reserve as the lender of last resort, market maker of last resort, once these private markets have been strengthened and the oversight of the markets has been rationalized and made more comprehensive with a much greater overall financial stability emphasis. So I guess that's my wish for the regulatory process and the central bank process going forward. This 13.3 facilities are unusual and exigent. They have to declare an emergency, et cetera. There must be other ways of doing that, but in the context of a much more robust market system, and taking up the suggestions that our panel has so nicely made today. So thank you all very much. Thanks everybody for tuning in and for sending in your questions. I think it's just about 4 o'clock and the panel is over. Thank you.
Thank you.
Thank you.
Thanks, Barry.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.